Hawes. I'm with Fairview Partners, doing business in the securities markets as Fairview Securities. I've actually been in the placement business longer than Chip Perkins, you can imagine that. We're a little boutique with 3 schools up in Connecticut, and we've done both equity and hedge funds for over 20 years. A little long in the tooth, but some of us have late life divorces, so that's what happens. We're here to talk about the alternative credits environment, and of course we've had 10 years of low interest rates, the magical money market investigation and project has created an environment which is a little bit bizarre for interest rates. And the panel's got an interesting staff of people who address the fact that everyone is now looking for new sources of return, and how are they going to deal with an environment where the 10-year rate is 1.5%, and how do you substitute for the traditional reasonable return you can get in the corporate and government bond market. So most family offices are wrestling with this issue. We're also looking at direct investments, as mentioned in the last panel. So I'd like to make this an open forum. Please feel free to interject questions, succinct questions, please, short questions. And I'll let the gentleman on the panel, maybe starting with David, talking about their background as well as their firm, what your business is.
Hi, I'm David Barnitt. My firm is Attract Capital. We work with independent middle market sized companies that need debt capital for transformational growth. I've been in the private debt industry for about 30 years, and I've had my own firm, Attract Capital, for 21 years. And we work across the spectrum of different debt structures, across the spectrum of different industry types. And we've seen an explosion in the private debt industry over the last 20 years. And I think it's an interesting topic for us to be talking about today.
We've seen, or I've heard some, I'm Tony Acquadro, I'm Managing Director with BroadRiver Asset Management. We're in the Empire State Building here in New York. We've seen I've heard some incredible returns today. So, if anyone has a Coinbase account, this is a good time to check your quotes, because what we're going to speak about, at least what I'm going to speak about, the returns are nowhere near that, but we're far more consistent, I would think. So, we're a private equity and private credit shop here in New York. We primarily deal with uncorrelated asset classes that are self-liquidating, self-amortizing, have a low correlation, actually no correlation to the markets whatsoever. And low correlated, low correlation to the market. So we'll touch on some of that later on.
And Philip, you want to go ahead and introduce yourself and your firm?
Can you guys hear me?
Sure. Loud and clear.
Yeah, sorry I can't be there. I'm flying out in a couple hours, so it just didn't match up schedule-wise. My name is Phil Toth. I founded a investment banking boutique called QueensGiant, and we do focus a lot on which are alternatives, lender platform finance, for example, and people originating certain type of different loans. And really it was born out of a need for investment managers to put money to work outside the bond market. So there's a more or less an alternative to the bonds. And I think like an alternative, or like a true alternative, really what Tony is and his firm is doing. So yeah, we do both. We're based here in New York City, and yeah, we focus on commercial real estate, lender finance, and then fintech. It dovetails nice with my position at Harvard, where I'm the head instructor of their fintech program. I'm also a faculty member of Columbia. Pretty much focused, yeah, on procuring either direct or indirect investments through funds or whatever into investments that may be interesting to family offices.
So Philip, if a family office was interested in a direct investment, is that an investor that or an organization that would be interested in your services?
That's what we do primarily, right? We would bring the deals, we would structure the deals, and a lot of the people that we talk to in the investor world are large investment managers, institutional. They're becoming more dynamic in recent years, so that they could capture more assets, as there's a lot of competition out there, of course, and consolidation in the investment manager community. And we would like to get some of these deals in front of family offices because they could be a little bit more flexible, perhaps, and do different things, or even pair themselves with some of the big managers in order to get leverage and whatnot on an operating company investment. So yeah, we are working with family offices. They can make direct investments in some of the deals that we're working on. We have a lot fewer of those available than we have institutional investors who generally think a lot the same way. So hopefully we can bring some investments to you guys that make sense.
David, would you amplify or distinguish your firm's activities from those of Phillips?
Sure. So we're completely debt focused. Our clients are looking for acquisition financing, growth capital financing, some plain vanilla refinancings to augment their working capital. And what we do is usually they're independently owned businesses, an owner operator of a company or an independent sponsor that's looking to buy a company. They're non-private equity sponsored deals. They're known as independent companies or independent sponsors. They can't, in order to execute their growth strategy, they don't have the ability to get all the capital that they need from the bank. They might need 10 million, they go to a bank, the bank says, we need 2 million, but I need another 8 million. They don't want to take equity, it's too dilutive, so they're stuck in the middle. So what we do is we figure out how to structure their capital need in a way that will give them all the capital they need and allow them to execute the growth program in a non-dilutive way so that they can usually double or triple the size of the company. So it's really relationship consultative type service that we get embedded within the organization. And we help them design the structure because we know I started the mezzanine debt business about 30 years ago, so I know all the different structures that are out there and all the different ways that you need to present your business model in a way that you'll get a strong response from the market.
Philip, would you say that you're in a slightly different market in terms of your services and what you're doing, or is it pretty much the same as what David's doing?
I'm not sure. I think it's a little different. I mean, we like to think we're unique, at least, in what we do. For an investment banking boutique, we don't really worry about how the deal size or who necessarily we're targeting, unless it's just outside of our area of expertise. So the alternatives spectrum could be very, very broad, right? What we're really looking for people to do, rather than corporate finance work, is asset level finance work. So if you're an operator and you could produce assets that produce yields, and you have a defined strategy of how you get paid there, we can do a lot with those assets to make them attractive to investors. Some of them just speak for themselves, but there are different types of capital to be deployed within the supply chain of those assets. Operating company can get a direct investment. In fact, we are working with some family offices on that, where they capture assets by investing directly in the operating company that's producing those assets, as well as financing the assets themselves. And you've seen a lot of the bigger asset managers react to that by doing that. They'll provide debt capital and equity capital so that they could secure the supply. We'd like to think that our firm, and we could talk about like general market, whatever, but we'd like to think that our firm is one of the only firms, especially in the boutique space, that could do all forms of capital for capital markets type work, which is early stage seed round to large institutional trades. I think where we fall short or really can't compete in our space is with public deals that the larger shops do, Goldman Sachs, Credit Suisse, and those guys. If it's a private investment where it's a negotiated transaction between the operating company or the owner of the assets, the sponsors, and the investor, really on a level playing field. It really depends on our ability to structure it, know the pricing. The big deals in the public markets, we could be expanded bandwidth to a capital markets team or a corporate finance team within a company, but it's very hard for us to compete with someone like a Goldman Sachs or Credit Suisse. Not only has balance sheet, but really is staffed up to do those public deals. Ours are bespoke transactions, and with that, I think, if it were similar, yeah, maybe, but for the most part, we're highly specialized, and we're looking for people who want to own assets or companies that want to produce assets that are not in really securities form, more in private debt or equity. So this panel where we have, alternatives, particularly alternative credit, that's our wheelhouse. People who are producing debt instruments or loans that people want to invest in directly rather than to a security, like a securitization.
So if I can summarize, I think what you're saying is that you are a source of funding for a family office that is interested in a project, a particular opportunity that they've identified, and you would be a funding source. So you're not necessarily an alternative to a fixed income investment.
We kind of are, because if you're a bridge lender, for example, and you want to go direct and buy the loans from the originator, right? Then we would work with we would work to facilitate that transaction, and we could get you a flow from them, or structure something with an equity piece beneath the bridge loan, or consumer loan, subprime auto loan, aircraft loan, maritime loan. A lot of the stuff Tony's going to know. I saw he did like tugboat finance and some other cool stuff that we worked on. Royalties, whatever asset produces a stream of cash flow, we could structure that with first loss piece, second, just like a private securitization would look like, and we could secure the flow, which is where, like I said, even the largest asset managers are worried about right now, because they can't buy enough bonds in order to put all their money to work. And it's very hard in this world to beat benchmarks by buying the same stuff everyone else is. So when you come up with these bespoke private alternative credit deals, you get a lot of demand for it from everyone. They're a little scared to go long, stocks in this frothy market, and they don't want to get horrible bond yields, right? They want to get somewhere in between. That means a lot of work and a bespoke underwriting, and I'm sure Tony can elaborate on that. It's a bespoke underwriting. It takes time, but there's a lot of demand for that right now.
Well, it sounds like you've handed the baton over to Tony very nicely. I'll let him tell you how he's offering an alternative source of yield and income.
Yeah, just to piggyback on what Philip said, we had a very large family office from Israel, and the patriarch said, "You guys get paid a premium for complexity." Right, so we're in parts of the market. We offer alternatives to fixed income, traditional treasuries, high yield, or whatever else, and it's all really illiquid in a sense. And we're in spaces where it's a bit more difficult in the sense that you need a particular specialization in knowledge of the asset class. So we have strategies in litigation finance where we're financing commercial litigation in Canada. We're funding short-term global trade receivables. I'm funding insurance companies and smaller insurance companies that need added capital to grow. We have life settlements. We're one of the larger players and older players in the industry in life settlements. And we're now providing credit lines inside of life settlements as well. So anything that really has somewhat of a predictability of the cash flow, or we're dealing with investment grade counterparts, is kind of where we fit.
So you're a registered investment advisor.
We are.
And you offer funds that are not, not money market funds. They're not liquid. They're private equity funds. Is that correct?
Private equity and private credit, yes.
Right. So, and what are the range of returns that an investor could expect from these vehicles? And I guess I have to ask also the liquidity, which was covered in the last panel.
So with respect to returns, I was briefly reminded by counsel that I really can't talk to returns, but I'm happy to, if anyone wants to reach me offside. But if the returns are better than what would be in the investment grade market considerably, and with the commensurate level of risk, with respect to what we're taking. And so. And
the sourcing of these different transactions or different strategies that is that all done internally, or how do you find royalties and litigation finance deals? Is that, do you have a whole team of originators in these areas?
We do. We have a portfolio manager in Toronto that's been in the market up there for 5 years and has developed a rather deep sourcing channel. For my insurance funding and finance, I have a portfolio manager that had managed to book over $50 billion from a larger reinsurance company that's now on our team. And with respect to trade receivables, I had I have a PM that was part of our team. The 14 came over from Barnitt, and he was a team member there, and then he launched several fintech companies, and we have a rather deep source of deal flow from him. And then within our life settlement area, we've been in this business, the team's been in the business for over 20 years, so the flow and sourcing channels are actually quite robust.
Interesting. There's a lot of ways to skin a cat in this environment, and I suspect that your firm might have use for David and Phil's firm and funding from occasion.
Yeah, there's some overlap that occurred, and we're always looking for different sources of deal flow.
Right.
And the firm was founded by two gentlemen that ran two separate family offices, so as well as myself. So,
can I just ask a question? I'll be quick.
Yes.
So you had mentioned high yield. Can you just describe the lay of the land and what you should be expecting from high yield this last year? I just got an offer in the mail from American Express that I get a high yield bank account for a 0.04% interest rate. Is that a good deal? Maybe you can talk about that. David? It seems to mean a lot of different things these days.
See, I'm in a different end of the market than I think than my colleagues here, in that I'm in the middle market and in the lower end of the middle market. And so the yields that we see on the mezzanine side are still in the low double digits, 10 to 12% with the opportunity for extra return. That's an attractive risk-adjusted return for many people, and I think that level of premium underscores the reason why there's been such a large growth in sort of private debt, as it's seeking the public market. The fixed income return is really not there, and so I think a lot of the growth in the mezzanine and the private debt funds is a response to the hunt for yield.
What kind of terms and liquidity are you talking about?
I'm not on the fund side, Marty. I'm on So it would be like a 5-year term.
Okay.
And it would be a bullet maturity, interest only, prepayable. Before that, maybe there's a bit of an upside.
Is there warrant coverage?
Yeah, there's some warrant coverage as well. So it depends on the deal, but in the lower end of the middle market, with deal sizes ranging from, let's say, 10 million to 50 million, there's not a as much as there's over $1 trillion in private debt, it hasn't flowed down proportionally to the lower end of the middle market. So there's still opportunities for people that are looking for return, looking for alpha in that middle market. Obviously, you have to be very focused on risk mitigation. You have to be very careful about your underwriting, your credit analysis, and the selection of it, especially on the direct lending side, because direct lending, there's no other institutional source of capital in the deal. So that if a lender's going in and they're providing a one-stop financing facility, you need to make sure that it's the right management team and that there's a margin of safety in the deal. But it really comes down to, at this end of the market, you can still get pretty good returns, but it's not an easy market to kind of make an inroad into. It's not a market that lends itself to quick transactions. It's more of a market where it's a relationship based, where you're building kind of a partnership, if you will, with the owner of that company, because it's a pretty important decision for that owner as to who his financing provider is going to be.
And as a mezz debt provider, are most of your loans asset-backed or?
No, well, I'm not the mezz debt provider, but I'll speak for the mezz debt industry in general. None of the mezz debt deals, for the most part, have any asset coverage to them. They might have maybe 20–25% asset collateralization. The vast majority of mezz debt is unsecured. It's to asset-light businesses that are EBITDA rich, and they really structure on the basis of a multiple of pro forma EBITDA. So you might be like a 3 times EBITDA, 3.5 times EBITDA, which getting paid 12%, 11%, 3 times risk. Maybe you've done a one-stop financing facility. Isn't such a bad place to be.
David, have you had any experience with family offices where you've been able to apply your financing skills?
Well, I think with family offices, it's interesting. We get calls. We don't do any sell-side M&A. We only help on the financing side, the consulting side with our clients. And a lot of them are looking for companies to buy on the private equities. We're looking for change of control transactions. Some of them are also looking for direct lending opportunities. And so they would be sort of somebody that we could show deal flow to. I think family offices have some natural advantages with respect to direct lending. There's more of a relationship touch. There's more of an entrepreneurial mindset. There's more of an ability to understand the challenges that the operator and the business is facing on a day-in, day-out basis. So many of our clients over the years have been functionally family offices. They happen to be most of our clients are people that have built businesses that own 100% of their company and want to take the next step forward, and they've accumulated significant wealth in that process. So they factor their family offices. So we've worked with many entrepreneurs that would have the technical status of family offices. But I think family offices could play a major role in this sort of this private debt explosion through having a specialization. And I think the lower middle market trading on their relationship angle is sort of a winning strategy for a lot of these family offices. Should they be interested in those risk-adjusted returns?
Phil, do you care to comment on your firm's activities with family offices currently?
I could give you an example of something we're working on right now that we're very likely to close next month, if that would be helpful.
Please.
Okay, so on that deal, family office in New Jersey, not too far from where I live, was interested in what we did. We showed them a deal where we had the senior financing on a tricky situation in the auto space, auto lending. It was a situation where the gentleman restarted his company and he really wasn't bankable. The credit fund offered up to $100 million in senior financing, and the auto loan platform didn't have enough equity for the $100 million line. So we introduced the two, and the family office said, hey, this is great. You already have the senior financing locked up with the street firm. What I'll do is I'll work with this guy who certainly knows a lot about auto financing more than I do. And we'll restart his company, and we'll be his equity partner. Initially, we went to them and said, hey, would you be subordinated debt to the senior line so that we could get this senior line and get the loans flowing again? And they said, no, we'd rather be an equity partner in the company itself rather than the SPV that own the assets. And that's where I think, I see it fitting in for a lot of the stuff that we do. Is that if we could find that more flexible capital, someone that actually wants to roll up their sleeves or be an owner in a business, then all of a sudden it's a completely different realm of possibilities with very attractive IRRs. Now there's operational risk, which people would tend to want to avoid. But if you trust the assets that are being produced through an auto lending platform, then the assets should cover all the expenses and then some. A lot of the institutional investors stray away from those situations. And you see right now, with everything moving faster than it ever has, is that platforms that are launching out there in the lending space with all the technology available, they're able to leapfrog incumbents very quickly or get VC funding and whatever and go out there and be $100, $200 million overnight in origination. The institutions aren't quite set up, ready to go and invest in those early stage companies. So for the most part, it's been VC people who really are not good operators or don't understand a lot of financial services challenges. One of them is that if you're a lender, market penetration strategies or scaling could be a disaster because there's an infinite demand for your product, which is money. And if you're loaning to subprime borrowers and all you're trying to do is scale to lend to subprime borrowers, you're going to get destroyed as the subprime borrowers don't pay you back. Now, we had seen that happen with a lot of VC firms who said, wow, this lending technology blows away what the banks have. It blows away what everyone else is doing. And yeah, they were right. But what they forgot is that you need to be very careful with scaling when you're in the lending business. The family offices, I think, have that right temperament to not go over their skis like the VCs do very often. And you could see a lot of instances, yes, there were some successes with VC investment and lending platforms, but there were a lot of failures, and I saw a bunch of them. I would have never let them do it if all they had to do was ask. I would have said, hey, look, bad idea, all right? So getting back to the question, examples, I think, investing in the platforms themselves, along with someone that has the ability to run a lending platform, run a commercial real estate operation, bolt on to a fintech company that has capital market options throughout the street or throughout the institutional world, they could help lever your returns as a family office. I believe that that's the sweet spot for the stuff that we do.
I just have a quick question or a comment. So 70-80% of all the fintech companies are being funded out of Silicon Valley by people who have no background in finance.
I believe that.
Right, and so it's just going to keep on coming in waves. I guess on debt capital is an example, right? One that was great at first and maybe not so good later. So
Okay.
That's that disconnect you're talking about. Phil, any other comments on that?
Yeah, I mean, the BlackRock guys were in there, right, on deck stuff. But you're right. They counted on independent service ISOs organizations in order to procure their loans. And you can never underestimate the possibility of fraud. People with their ear to the ground, or subprime auto is a great example, as well as small business like OnDeck, is that the dealers, the people just want to sell a car, they might not be filling out the application the way you want them to fill it out as the lender. The same thing happens for ISOs who you're paying points on the business loan. So it's relationships really do matter, right? And if you're too far detached from the actual borrower, if there's an in-between or a go-between, then you're going to get gamed. And that's what I think that a lot of the fintech in the lending industry didn't understand. But they've learned it better. I mean, we've progressed. I think, like I said, I think the family offices are more suitable for that because of their temperament and maybe just kind of, I don't know, if they own a family office, they probably understand business, and they're not just throwing money out there for no reason. So yeah, you're right. And real quick too, just so we don't badmouth fintech guys, because I am the head instructor at Harvard's fintech program. One of the things we say with the fintech platforms, and we try to reinforce, is, hey, are you making things more efficient? Right? Are you saving on cost, or are you actually improving the performance of the assets through fraud mitigation, through better targeting, et cetera, et cetera? It can't be just that everything that we've done in finance, has to be replaced or rethought through. Pick a specific problem that you're addressing in terms of efficiencies, and anyone who's gotten a mortgage lately will realize that the mortgage industry is not very efficient at all. Fintech solutions can be very, very applicable there, and in many other ways. You look at commercial real estate funding, where 13 or 14 people need to look at the same damn loan file before it gets funded. And we could talk about blockchain or other technologies that could make it so that fraud is mitigated, efficiencies are implemented, and we're all better off for it. If that's a fintech solution that you provide, we're keen, right? If it isn't, then you know what? Maybe you're just dialing for dollars, and we don't really have a lot of people that invest in crazy investments. That's really not people that we know, right? But yeah, there's a lot of that I think has gotten better. The conversation is more sober than it ever has been. Personally, very optimistic about what's going on in the space. So, yep, there's been a lot of problems, no doubt, and I appreciate that question because it is apropos.
David, do you care to respond to the observations?
I would say what I see in the fintech side is that I would agree with Phil in that there's this view that the algorithm is omniscient. And I think what you realize is that you have to implement some of the more traditional procedures that small community level banks have used, which is KYC, know your customer. You need to have that soft intelligence about your customers. We've worked with a fintech company in New York State. They're on the micro lending side. They've done about $2 billion worth of micro loans in their history. They've only written off about $25,000. Okay, and that's because they do extensive due diligence on the front end for all the people that are coming in for these micro loans. They know their customers, they know the business that their customers are in. It's really a local kind of a grassroots type business that this entrepreneur has built. And it speaks to how you manage your losses and how, notwithstanding that, his business is not tremendously scalable to other parts of the country because he has an algorithm, he's developed the software, he's tried licensing it. He's going to be successful. He's done some good wholesale deals with respect to his technology, but it speaks to the opportunities that are available if you know your customer, if you manage your losses, and you kind of have your finger on the pulse of what's happening in the regional economy. And that's also a theme, this KYC and understanding the local market that has really gnawed away at the banks, and particularly the big banking industry with respect to how they're lending within their communities. As banks have grown gargantuan, they've stripped the credit decision authority from the local marketers. They've reduced those people on the front line to mere deal intake officers. And so when you hand a deal off to a relationship manager of a super big bank, it gets sent to another part of the country and it's being reviewed by a team of people you don't even know who they are, you haven't had interface with them. And so I think because the local banks, much like on the fintech side, they've kind of unbundled the soft information, the KYC, the relationship angle from the prospect. It makes it more formulaic, more rigid. And I think, what this all means is that as banks have gotten further away from it, I think it's created large penetration on behalf of these alternative asset managers on the private debt side. Banks are not meeting the needs of lower middle market companies. They have vacated the lower middle market corporate finance niche. They're not there. And as a result, they want you to think they're there, but I'm not talking about community banks, I'm not talking about regional banks, but I'm talking about the mega banks. Very good people work there, smart people work there, and I think they provided a huge opening. I'd be interested in what you, Tony, because I think you play in the niches here, that the banks have just created these voids, and there's opportunity for opportunistic managers.
And I wanted to kind of buttress your question you're going to answer just with one other comment, which is that one of the outcomes of on-deck capital is that they have tightened up their risk metrics. And now there's actually a whole business of other lenders taking the on-deck pushes out the deals they reject to a whole ecosystem of other lenders, right? So there's that which is now occurring. And so if you ever actually listen to like these podcasts on other allocators or how they allocate, they're all talking about the personal relationship, how well they know the person, getting back to what you're talking about KYs, et cetera. And whereas this has become, as a model, a lot less, desensitized, and it doesn't, the tech doesn't really scale. So I just want to, kind of buttress that. I talk about this other alternative lending area that's become personalized, on-deck rejections, and then also the fact that people who are allocators to funds would never allocate to a credit risk the same way that credit companies are these larger fintech firms are allocating. It's all, for them, it's personal, right? So.
Can you sum that up, David?
I'll let Tony take a shot at it.
I don't want to take a shot at it. I'll let David take a shot at it. But the way that we use fintech, and there's so many verticals in fintech, right? We're funding short-term trade receivables that the banks used to do prior to the financial crisis. And after that, because of Basel III requirements and a number of other issues, the banks really kind of stepped away. So there are some very, very large banks that do what would be the investment grade funding, and that's 50, 60 basis points, 70 basis points on that side of the equation, which we can do, but it's not profitable. The other side, you go all the way to the other side, you have factoring, right, where the receivables, those receivables aren't as, people that are selling their receivables on the other side of the equation, or folks looking to meet payroll and whatnot. We're kind of in the middle of that, and the factoring that, not the factoring, but the receivables that we finance, we use platforms, probably 25 plus out there and growing. But they're really a conduit of deals. We do a very, very heavy underwriting, financial underwriting, before we enter into any of these transactions, but we have screens and mechanisms that we use in there. And the global trade receivables company is, we're aiming to, the $1.5 trillion marketplace, knock 500 billion off for what would be commodities, and we're really in the industrial sector. Right? So operations that we can go out, touch, feel, examine, and that we're comfortable with, and you really have to have feet on the ground, and you have to understand the asset class, and you really have to do your own diligence. So I'll let you tackle the depth if you can.
If you want to just talk about the ecosystem that's kind of erupted as a result of on-deck rejections, et cetera.
I'm really not an expert in that end of it, Marty, so, I do know that there's a lot of these payday lenders that are, I know a little bit about that and sort of the SME financial ecosystem, but I'm really not an expert in sort of the remarketing that all of this engaged in.
I could take a stab at it. So, it's not just on deck. I mean, there are a number of follies that have occurred in the lending platform space, right? And it's not too difficult to understand why. If you're out there and your job as the CEO is to go out there and find someone to invest in your platform at the highest dollar, well, then you get what you asked for, right? If you want to get someone that actually understands the supply chain of financial services and wants to be strategic with their investment and offer something more than money, then you're going to find someone to avoid the pitfalls that on deck fell into, right? And it goes on and on. You know, Cabbage was. Let's not forget, people like Cabbage suffered from the crisis, right? When PPP pretty much made business lending useless, right? So sometimes it's no fault of your own that you just end up in a bad spot. But if it's certain things that you're foregoing that have worked forever in the lending industry, like KYC, our panel spoke about, then you're pretty much going to be in a bad spot, right? So part of it is just finding the right investor for your fund, knowing what you're good at, and you try to adhere to best practices in the lending industry, but at the same time, looking forward to where we're going instead of where we are. Now, if you're rooted in some reality, you have investors that understand that reality, then you're better off. Unfortunately, the money was so attractive a few years ago to go out there and get these absurd valuations. I was almost kicked out of parties saying it was ridiculous. Okay, they didn't want to hear it. Right? You don't blame the shareholders for taking the valuation, but they got what they asked for. They found some investors in there that were trying to displace the rest of the world, and they got burned.
I think we have a question in the room, and Marty, there was a question on the screen from one of your subscribers. Go ahead, sir.
Yeah, I was just curious, given your businesses, how often, and then from a percentage standpoint, Phil spoke just about taking an equity position in some of these opportunities. So from your perspective, how often are you seeing that? What are the size of the positions relative to what you're lending? That you guys, if you see an attractive deal, that you're also getting involved in a part of the equity stack.
The question is, how often is there an equity opportunity in your transactions?
The equity opportunity is usually spoken for by the time the deal gets to our desk. Sometimes the lender might want some additional upside. I'd say it's very situational. The normal lending rate, the leverage break point of about 3 to 3.5 times is usually all debt. So I'd say it's pretty rare in the deals that we see, but it may be different for Tony or Phil's deals.
We love it when we see it because it's a really great alignment of interest to be invested in the assets themselves as well as in the equity in the company. And we try the best we can to make some of these alternative credit deals look less like expensive bank lines and more like strategic investments. So as much as we can.
We participate on with respect to our insurance. When we're participating in insurance blocks or lending in there, there's an equity element that we may make in there that aligns our interests with our investors inside of our life settlements. I mean, those are we're buying underlying policies that are backing these pools. So we have both the credit side where we're lending to even some of our competitors to, and then we have the longevity and equity side for that occasion.
Just as a follow-up, anything in particular from size, like relative to where you're lending? So if, let's say, it's $100, right? Like maybe you're in for $95 or $80 on debt and $20 on equity, or percentage of the, just relative to size of where you are lending versus equity.
Most deals that we see in the independent middle market space, it's probably about 20%, 25% equity, which could be a combination of real cash equity that the owner's putting in, as well as a rollover equity or perhaps even a settlement. all of which would qualify as junior capital equity. So I'd say that's 80-20.
Okay, and Jay, can I ask you a question, because you're on the private equity side, when you're putting together your deals, how do you look at the debt structuring versus the equity?
Yeah, I mean, it really is about how flexible we can get, and back to everyone's point about alignment of interest, and then sometimes it's timing, right? I think going back to the relationship piece, if you've got a relationship with someone on the debt side and you know they like to get involved or they'll take a piece of equity, you usually try to get them involved sooner in the process versus if you're speaking with someone who traditionally is just like, hey, look, I'm only focused on the debt and that's it. So a little self-serving question, though, just try to find out who wants to be involved and in what capacity.
Last question?
Phil, do you have 10 cents on that?
Oh, 100% agree with that. Very, very similar to what we see.
So there was a question about crypto bonds, if you have a 2-second comment on crypto bonds.
I'll yield it to the.
Just are you guys doing anything in crypto bonds? No.
No crypto bonds.
Okay, Rob?
I had a quick question. When you are doing debt, how often, what percentage of time are you doing multi-structures of debt? Like you're doing debt senior and you're doing some mezz, or are you strictly one instrument?
What level are you in the debt markets?
We're usually senior secured on the debt side.
Senior secured. And you are as well, correct?
Senior unsecured
Unsecured.
or junior
And
unsecured.
Philip? You have,
Yeah, it depends on the asset class, depends on the operator, it depends on the investor preference. It's hard for me to really comment.
okay, we had one question that came over the screen about the length of the loans that you'll make. Is there any general comment you can make on the term that you offer on your loans?
Depends on the asset class, but like if you're a senior, if you're providing a credit facility, it's usually three years with, it's the amortization on the loan and at the end of the term that really matters, I think, for us, the way we see it.
For us, a weighted average life for what is trade receivables is 60 days, right? Where on the insurance side, average weighted life can be anywhere from 4 to 6 years. On my senior secured products, it's 3 to 4 years.
Mezzanine is usually 5-year note maturity.
5 years on the
5-6
mezz,
years, yeah.
right, okay. Well, I don't know if we answered all the credit questions that people have, but it's always good to know a good banker and someone who also offers good alternative investments. So thank you very much for your questions and appreciate the time from Marty in front of hopefully some people who are watching us on the TV.